Hey guys, it's Will. So in this video, I want to talk about how it is that I trade in a market that's going down. Now, some of the things that we share on this channel, I've realized have become more and more insightful and less and less of a phenomenon that the things that we share on the channel take place because of how deeply involved we are going to events, talking with other analysts, doing the deep analysis on all of the stocks that we do analysis on. And I would say that the number one thing that has led to our success in being able to invest in the market is being able to determine direction of stocks and then invest in them accordingly. So for example, if we know that there are tariffs that were coming here on April 2nd, I think there was about a week where there's a sentiment around get ready, the market's about to sell off. There's also a lot of news that comes out, like the tariffs that are hitting in the last few days and how much of a percentage hit that's going to be on the United States GDP. So most likely investors would sell as a result, and we start to see that kick in. So one of the things that we look at is, the same thing that's true if we are looking at a bull market, same thing is true that when we're looking at a bear market. If we have certain indicators that we can look at to determine the direction, then we can trade that direction. So that's the first key, the direction of the market. If we're able to determine direction, we're able to then buy and sell at points that would make sense for that direction to continue. So one principle, this is actually number two, is that the trend has a greater chance of continuing in the direction it's going than reversing. Now, this has been proven, and that's why it's called a trend. In fact, it has a greater chance of continuing than reversing. Maybe it's not by a massive margin and it's just a smaller margin, but when you're looking at the market selling off recently, the number one thing we're looking at is, okay, now if we know that the market's going down, this brings us to number three, and we have the direction that we're going to trade and we see it go in that direction, and now we're saying, how can we actually capitalize on that? So number three is picking the right assets to trade. Now, once you have a market, whether it's the space market, the AI market, the semiconductor market, maybe it's the quantum companies, each market moves kind of together. And sometimes the entire market moves together. In this case right now, the entire market is moving down. And so with that in mind, we have the ability to take advantage of that in any of the individual markets. Now, some markets get hit harder than others or grow faster than others based on different indicators. So this brings us to number four, which is when you pick a market, pick the assets that have the greatest chance to grow or decrease in that market. So, for example, if we're looking at tariffs, we can look at tech. That's one thing. But maybe software isn't effective. It's not affected as much as, for example, semiconductors. So we go to semiconductors knowing that a lot of semiconductors are shipped from other countries, and the businesses that rely on those other countries are going to have to maybe pay more, or the stock, the investor sentiment around that business model of outsourcing from other companies doesn't look so good when tariff prices go up. And so with that being said, we could look at semiconductors and draw a conclusion that out of the different trade avenues in tech, semiconductors most likely will take a hit. So we choose semiconductors. Now, when choosing the specific asset, we're then going to make sure that we're getting the direction right as far as how we trade the asset. If we believe it's going down, obviously we're not just going to buy the dip. Now, it might just continue down and you get caught trying to catch a falling knife and it just keeps trending down and you lose money. So rather than, let's say, buying or even putting options on, let's say, buying a put that we think that semiconductors are going to go down, we actually go and place a short-term trade throughout the day on SOXS. So essentially, there's these different index funds that make up entire markets. Some of them go up when the market goes up, but some of them go up when the market goes down. So SOXS, for example, it goes up about 3% every time the semiconductor market goes down 1%. So today, for example, when we were trading inside our live session in Stockmate, we go live there every morning at market open. And one of the things that we're focusing on today is how can we trade SOXS? So we ended up buying the stock that goes up when the semiconductor market goes down. And that's exactly what happened today. It ended up going down about 15 to 20%, and we were able to capitalize on about a 9% swing investing in SOXS. So essentially betting that investors aren't going to see that semiconductors are a very good play in that moment, as there's a lot of panic in the markets, and we simply took advantage of that momentum. Now, as a result, we're able to capitalize on 9%. If we wanted to go even more risky or have, let's say a very, very clear direction, you could do options, which might be, obviously more risk, but could potentially be more reward. Now, we were just feeling it out, and I also wanted to introduce options in a way that's more digestible, as this morning was quite fast-paced for our beginners inside of Stockmate. I wanted to make that easy for them. But I'm sharing it here on YouTube because the live sessions that we do simply are a refracting element of all of the different market philosophies. Sometimes we're in a bull market, sometimes we're in a bear market. Sometimes certain industries are going to do better than other industries. Right now, we're focusing specifically on the hardware, on the inventory, and the materials that come from other countries that go into some of the most profitable companies in the US, that right now those materials are going to go up in price, which means that they're still going to buy them most likely, but that market is going to take a hit. So it's still a solid kind of market to look at, maybe not necessarily collapse, so it can have some steadiness, and that actually allows us to see the patterns clearer. So trading a market like the massive semiconductor market is smart. The smaller the market, the less predictable it becomes. So even though you want to niche down and find specific markets, we also don't want to go so small that it's very unpredictable, or such a small market cap that one institutional buyer will absolutely, rocket or, let's say rug the entire stock. So we want to keep the market caps high. That's why we focus on semiconductors as well. Now, number 6 is absolutely picking a high velocity trade or investment and sticking to a plan. A lot of times people think that they have to think in order to make a good trade. But most of the thinking, comes before. Once you place the trade, there's no thinking involved. It's like a hedge fund or like any institution. Once they place the trade, oftentimes it's left up to a machine to trigger the buy or sell order, if the machine wasn't the one in the first place to trigger the order, the buy. So what we're looking at in the markets with this high velocity focus is you want to pick companies or different assets that are demonstrating, if at least on an intraday, on a short term, if that's the trade you're doing, you want to indicate that it has the type of velocity and change in volatility that could make you a substantial profit. Once you go in, you have your risk managed, and if it doesn't go according to plan, you cut your losses at that point. But that you're going for a profit that's greater and much greater than where you cut your losses will allow you to, over time, be able to win trades, especially if you stack that with making educated investments, identifying patterns, the technicals, the financials, and then playing news like this that's happening in the market. Stack all these things in your favor along with a consistent trading plan, and that can really help you to be able to make more consistent profits and grow your accounts consistently. So guys, those are the things that we focus on. And that number 6 of high velocity is for more advanced traders. If you're just a beginner, I recommend having patience, maybe even starting with a paper trading account or just $100 or less in your account to do fractional shares and see how the markets move so you can really test it out. Now, if you're a beginner and you'd like an A to Z lesson library on how to invest in the markets, I would encourage you to check out that second link in the description. We go live there every morning, and I would love to see you there at Market Open. Thanks again for watching. If I earned your thumbs up, hit that like button. do consider subscribing, guys. I'll see you in the next video.